So welcome to the 2023 Q2 partner presentation for Bonhoeffer Capital. Got the disclaimer here that it's for informational purposes only. So what I thought I would do initially here is just go through a little bit of sort of where we are and where we're going with the Bonhoeffer Fund at this point. So Bonhoeffer was started in 2017. Our initial strategy was basically focusing on value and special situations in emerging and developing markets, primarily looking at sort of, growing and healthy businesses in industries in interesting parts of the world that were selling for less than intrinsic value. Over time, what has happened is we've sort of the strategy has evolved to include frameworks that are focusing more on growth and the drivers of growth. And you can sort of see that, and we'll see that in the next slide when we go over sort of an overview of the portfolio and sort of what's in it today versus over time. And so right now, in terms of more of this, I would call it more of a growth or MODI type strategy. We have about 50% of the portfolio in that strategy. In that extension of the strategy. And what we do is we focus on firms in that strategy that generate excess capital, excess cash from their operations and allocate, and then management allocates it in ways that are positive in terms of the growth of value over time. So here's the current portfolio, a Bonhoeffer portfolio. As you can see, the initial sort of set of areas we looked at, we still have a good number of those in the portfolio. This is more of just an extension as opposed to an outright change of our strategy. And so those include compound mispricings. Those are situations where there's a security that's cheap in addition to the underlying stock being cheap. Mischaracterized firms, these are firms that are basically characterized by analysts in one industry, but really they're probably part of another industry, and therefore there's some potential for increase in multiples as time goes on. Public LBOs, which is basically companies using debt in a very strategic way that actually can enhance the value of the company. Consolidation, which is something we've talked about in some of the previous slides, and that's more of management focusing on industries that are really consolidating versus fragmenting. And that's a very important aspect, because as businesses are consolidating, you get a tailwind versus fragmenting industries where you end up with a headwind. And then capital allocation champions, those are things where we look at sort of the return on invested capital that's associated with businesses and focusing on management that can increase that return on invested capital. There's a metric called return on incremental invested capital that we can use to measure that over time. And what I'm going to do is right after this, I'll give you a specific example of a firm that's done that, and sort of the kind of firms that we're really spending most of our time these days looking on versus sort of in terms of looking for companies that sort of meet this type of a model or have this type of a way of doing business. As you can see, the Bonhoeffer Fund still has a very much of a value focus. Our weighted average PE is significantly below both our international composite and international small cap value, but we do have higher growth for that lower multiple. And I think that reflects in sort of some of the new additions we've made to the portfolio over the past 18 months. And then you can also take a look at the EBITDA and debt. The debt's modest, and the EBITDA again is there sort of like a 4.2 is a relatively low EV to EBITDA multiple. And so what I thought we do is we just sort of go through and we sort of take what's this enhancement really mean? What is it? How does it really manifest itself in the portfolio? And I thought it'd be good to sort of show you an example of what's really going on in terms of some of this stuff. So primarily this approach is we're doing a different starting point, but we're retaining a value approach. By that, I mean, each one of the firms in the portfolio will review where there's is there a moat? How much of a moat is there? And then if the moat is widening. And what we're focusing on are firms where moats are widening. And then in some of the in the last quarter presentation, we talked about companies that were bigger. If it's bigger, it's better. And that's the kind of stuff we're looking for. We're looking for situations where as the company gets bigger and as time goes on, time is going to be your friend as opposed to your enemy in companies, let's say in companies that are where there's more fragmentation and you have more of a headwind versus a tailwind. So the first thing is identifying the firm's moat and determining if it's widening. And we can do that by taking a look at the return on invested capital, but probably more important, the return on incremental invested capital. And what that represents is each of these firms have cash flows coming into the company, and basically management has a choice of what to do with the cash flows. They can distribute as dividends, they can repurchase shares, they can increase operations, make it better, do an M&A. And so we're looking for management teams that are basically investing it in a higher rate of return, or relatively high rate of return in terms of invested capital from that perspective. And so some examples of that, and I think this would probably, is Ashti, which is a equipment rental company. The return on invested capital after tax in North America is close to 19%. The growth is 15 to 20%, and the PE right now is around 14. We bought this company back in 2019 that had, maybe the PE was a little bit lower, but had sort of the same sort of profile. And what's happened is the company's done really well for us as a result. A second company that's done well over the past, let's say, year or so is Builders FirstSource. That one's probably up about 100%. And again, had a very similar type of situation where we had a really high return on invested capital, 35%. Again, growing at 15 to 20%, and the PE right now is 11. So again, this one still seems to be, relatively modestly valued. And then the last one that we also invested in last year, it's gone up some, but not nearly as much as Builders or Ashti at this point, is Asbury Automotive. And these guys are basically an automotive dealer group. Their return on invested capital is close to 20, 15 to 20% growth, and then PE is 6. What's interesting about at least both Asbury specifically is they've got a specific plan to get to really high, to support these high growth rates over the next 5 years. And so what we've also done is we've gone through and reviewed the existing holdings. One of the enhancements we've done with our valuations is looking for companies that can continue to grow without relying on multiple expansion as a driver of growth. And so that's one of the things that we've really been focusing on lately. And all these companies, as you can see, are internally growing very fast. So if the multiple doesn't expand, you're still going to get a nice tailwind from that. But what you're hoping is that their multiples imply relatively low growth rates, so that over time you'll get both the growth of the underlying business in terms of the earnings, plus you'll get the multiple expansion. And that's where the multiplicative effect can happen. You really can get some really nice appreciations from that. And so I'm going to go through a specific example of Asbury to give you an idea. I thought it would be a good idea at this point to basically sort of, before we dive into more of the specifics of what we're looking at in the fund, is to give you a real world example of a company, so you can see how this sort of plays out in our implementation of these more growthy types or MODI type strategies. So Asbury is the 6th largest automobile dealer in the US. It's a collection of local markets where the largest player has network effects and economies of scale on a local basis. It's developing value added products and services to increase the stickiness. Those things are like auto service and financing. And these are one of the characteristics we like to find in these businesses. Our people are just, especially in the distribution businesses, are finding businesses that are developing these value added services. You can look at some businesses that are distribution businesses, for example, the electronics distribution businesses, where this really has not matured or been as evident as other businesses. And you can see the differences in the returns on capital. The customers are much more price sensitive, and they become less sticky. So that's one of the characteristics that we're looking for in sort of the businesses. And from the management team's perspective, what are they really doing? What's interesting about this is it's a large and slow growing TAM with easing pent-up demand right now. There's a lot of pent-up demand, and depending upon what specific make or manufacturer you have, the pent-up demand is still there. For example, a lot of the Japanese, the Toyotas, and those types are still there. The US manufacturers are basically pumping out autos like crazy. So the pent-up demand, you have an excess of inventory. So if you look at the amount of inventory by make and model, you'll sort of see that sort of playing out. But what's really interesting here is these guys are sort of adding, they're a value-added distributor in terms of being dealers. And what we've noticed over time is their return on capital has increased. So right now, the return on capital has increased from 13%, I call it 10 years ago, to right now about 20%, excuse me. And they have some debt. So you're probably talking returns on equity in the low 30s for this type of company. What's happened, there's a metric called return on incremental invested capital. Again, that's the cash flow the company gets, what's the incremental return that they're making on that capital in terms of reinvesting. So that's 25%. And if that continues on, the return on invested capital should approach 25% because that's the incremental that you're adding to the existing return on capital the company is getting. And what's really driving this? And this is where we dive in and we try to really understand this and make sure that this is something that's sustainable, because if this is just a one-time thing, then it's not going to affect the value. But if it's a sustainable improvement, then that's where it's going to change the value. So what's really happening here is you get operational improvements. Asbury has Click Lane, which is primarily a way you can buy cars online, and you can also schedule maintenance and the other types of things. So that's sort of like their online tool to basically the sales and service that they provide for their customers. The other thing you can see in terms of what's going on there is the higher inventory turns. How fast are they moving cars? How fast are they matching customers to cars? And you see that happening over time. So again, that's showing that this is increasing. There's local economies of scale, and then you also have merger synergies. And what's actually happening with Asbury also is they've also divested a number of companies, which I think is also showing what the management team is doing is they're just not buying other companies. They're buying them and seeing, do they fit into their model? Do they fit into their footprint? If they don't, then they'll sell them. And that's really showing active management beyond just buying companies, in terms of trying to maximize the return on invested capital. And this is part of their framework, and this is part of what they talk about in management presentations. But what we try to do is, you can talk about it, but when you see it in the numbers and you see it in the actual metrics going on, then you really get a good feel with, okay, here's sort of a really good company to buy in sort of this space. And then so another key aspect of this is, you basically, do they generate excess cash flow? Because if a company is capital intensive and all the cash flow has to go back to reinvesting in the business, then in essence you're wed to that business. But what happens is if they have excess cash flow, which these guys do, so 65% of their cash flow is not required for growth, then they can go and do additional things. And so these are the things that they can do with the excess cash flow, and they've successfully done over time. So consolidation, they've done 16 acquisitions since 2014. Again, we talked about the divestment piece of that. I think it's important when you look at companies that are doing M&A. Are they going through and rationalizing the operations of the business to make sure that piece of it, because that's the easiest part, at least when you have control of the business, to actually increase the return on invested capital. The other thing they've done is they've repurchased shares from 2014 to 2019. They repurchased 36% of the shares outstanding with an average cost of 68. What's important when looking at repurchases is the percentage of the amount they brought in, but then also, is it significantly below the existing price? And it clearly is. The price of Asbury's like 240. Right now, the company is in another one of these times where it's buying back shares. It's bought back like 5% of the company in the past 6 months, primarily at prices around 197, and the price is 240. So again, they've been very good at opportunistically buying shares when the price is low. And if you take a look at a chart for the first part of this year, you'll see they bought on the lower end of what that is. Repurchases can be good, but you need to really need to have some kind of a price focus on it. And these guys appear to have that. So that's really becomes value enhancing to the other operational improvements that they're making in the business. So right now you've got a modest valuation at 6 times EPS. The historical growth rate is like 30%, and the expected growth rate is 15 to 20. And that 15 to 20 may actually be low. But the reason why the market is valuing this at 6% is just the concern about the cyclicality of the business. The bet we're making here is that this growth can continue and more than offset the downward cyclicality that's going to be happening. So everyone acknowledges, and you even take a look at their numbers are going down from what they were a year ago. But the real question is, what's this thing going to look like out into the future? And so therefore, what we're trying to do here is we're saying the bet that we're making here is we're basically saying, okay, we think this company's gonna basically do better than what the market's thinking, because out 5 years from now, we think this company is going to be making, $50 to $55 a share, and it's only selling for 240. So that's a pretty cheap pretty cheap proposition. That's on a normalized basis, not on a top of a cycle basis. So this gives you an idea of sort of what's happened to Asbury over time by following that strategy. I just thought this would be a good chart for you to sort of take a look at of illustrating the type of approach and the type of companies that we're looking for. You'll see over time, back in 2012, 2013, they had about 31 million shares. That was before they did the large buyback. And you can see the number of shares went from 30 down to 19 as they bought back a large number of shares. And what's interesting is if you go down here, you take a look at the net income. So the net income went from 110 to 180 million dollars. So it's up 80%. But then take a look at the price, the amount per share. The amount per share went from like 350 to 965. And what that really shows is just a huge amount of leverage from buybacks. And that's exactly what Asbury's done. And right now they're in another cycle. The number of shares outstanding based upon the current earnings this morning is about 20.6 million shares. So you can see they bought back a significant amount, 5% in the first 6 months. And if that continues going forward, then it's sort of this process that just sort of adds on to itself and really makes it a very interesting company over time. So the other thing we're doing here is that's a specific example. Now what I want to do is pull back and say, okay, what does this imply in terms of some of the themes that we're following as the Bonhoeffer Fund in regards to how we're looking at companies. So what we've done is we're focusing on two areas of the market that we think where there's some mispricing. The first one is sources of unrecognized growth. Like, for example, we don't think the firm pricing shows up in areas like M&A. Most analysts don't account for M&A as a future in their valuation models, buybacks and corporate actions. And so what we're really trying to capture is, okay, management team's going to do something. It's not necessarily here today, so the analysts aren't going to put it in their models, but we have a pretty good feeling for what these guys have done in the past that they can continue to do in the future. And part of that's looking at the market and sort of seeing what's really going on in the market. We'll go into that next section. Is it consolidating or fragmenting? But that's another important piece of trying to sort of put this together. So again, we're looking for the transition from lower return on invested capital to higher return on invested capital. We're using the incremental invested capital to really sort of measure that. And we're looking at other market factors and strategies to sort of enhance that or make that grow. And then going forward, if that strategies continue, it should continue to make it grow like that. So some examples of companies where this has happened. There's a company called Autohellas that I think we've talked about in the past. It's a Greek rental company that's using similar types of strategy in that market in some of the Mediterranean car rental market. There's a company called TerraVest that basically follows a similar strategy in what I would call sort of the metal bending industries here in North America. They're rolling up and acquiring companies in sort of the steel bending area. And so they're able to get historically, they've been able to do really good. Their returns on invested capital are almost like 30%. And the company's only selling at this point. Today, it's probably selling for like 8 or 9 times that free cash flow. So again, those metrics and they retain pretty much earnings, and they've done a lot of these things that we've talked about. Their management's very flexible. I've talked with the CIO a number of times, and they really have a really interesting approach of doing that. And then Academy Sports, which is sort of they're like a competitor to Dick's, I think, that has a lot of momentum in the areas, and there's just some interesting things with that. So these are examples of companies that are going from lower returns on capital, and part of it is scale and the other things we talked about, but trying to identify and basically filling the portfolio with more of these types of companies, I think, is what the message is what we're doing at this point. And part of the other thing too is another approach we take a look at this is take a look at a value chain of a specific industry like automotive. Okay, we know automotive is going to grow over time. What we want to do is where in that value chain do we think there's the profit pools? Where we really see it is in the dealers or distributions. It's the profit pool is much bigger there than invested capital than, let's say, the OEMs or other parts of that overall value chain. And what that leads to is two strategies, as we outlined before, that are becoming more prominent in the portfolio. This accretive consolidated growth, which we'll go through in subsequent thing, and then also capital allocation. And I've got a specific example that we'll go through. There's a gentleman named Henry Singleton who ran a company called Teledyne, which basically has compounded very well over long periods of time. We'll go into some of the specifics on that. when we get to that part of the presentation. So we'll step back here in terms of looking at value chains. What we've looked at is, let's say we've looked at 4 different areas, and where in those value chains is most of the value actually being developed. I mean, there's different in each one of these, like for the autos, there's components, which are the components that go into autos. There's the OEMs, those are the big guys that are actually making them. There's distribution and service. Where are the biggest profit pools? In auto, we think it's in dealers and distribution, and therefore that's where we've sort of focused. And then we look at sort of the growth drivers, sort of what's happening there. Is there consolidation, which helps you quite a bit? Is there organic growth? Organic growth, let's say in automobile business, is going to be, GDP. So there's not going to be a lot of organic growth, but consolidation can make up for that in terms of growth itself. You're dealing with cyclicality. Now, if you're a distributor, the nice thing about auto dealerships is they've got the service business, which has a tendency to offset the more cyclical buying of autos. Everyone always has to service it. So basically those somewhat offset. And especially as people are holding on to autos longer, the service becomes more important, because service is something that you're going to have a higher demand for as cars are owned more and more. And then we're also looking for businesses that sort of are transitioning, or the market really doesn't sort of, they're in the way that the analysts look at it is in a different industry group than what we would normally sort of do from that perspective. So now we're going to go to the next part, which basically this is sort of a review of what we had done last time, but I think it's important to sort of talk about this, is when you get, what's the characteristics of getting bigger is better, because that's a key theme amongst the 3 companies we mentioned, and pretty much all the companies most of the companies that we're looking at now to put in the portfolio, because this is an important aspect, because as you get bigger, you can get economies of scale. And this is where you can get unanticipated, the company's getting better, and that's not necessarily going to be anticipated in the market to the extent that it probably should be. So those first pieces, economies of scale, there's higher margins with larger turns. There's local, and there's 2 different types. There's local and national. Most of the businesses we look at have somewhat of a local economies of scale. And cash flow, basically, and this is the different sources of cash flow and what's the best type to have. Organic is probably the best. You can have more control. You can generate returns without having to buy companies or basically creating goodwill. The next one is sort of like consolidation, which in some markets, if you don't have organic growth, you really need to look at consolidation or more efficiencies within the companies to generate growth. And it can be in a geographic or functional area. And so we've seen this with companies like Asbury and Ashtead. I mean, Asbury's bought different groups in different parts of the country and basically sort of grown that way. And Ashtead's done the same thing. And then what we'll do in the end is we've got, capital allocation of the excess. And those are things like buybacks, dividends, and spinoffs, or sales in the case of like Asbury, basically selling or divesting of companies. And so the key thing behind all this is basically to basically have these cash flows and for management to appropriately allocate them. And that's the key thing when we talk about this capital allocation champions. That's what we're really referring to, is managements that are doing this on the highest level. And then the other thing that's interesting about consolidation really helps. And just in general, I think it helps, is sort of this idea of fragmented versus consolidating markets. So this, again, is a sort of an overarching theme, I think, that we've sort of have been incorporating, is most of the businesses that we're looking at and that we're focusing on, they're spending a good amount of time on, are sort of consolidating versus fragmenting. So consolidating market leads to primarily higher returns because the number of competitors is consolidating. Fragmenting market leads to more competition, which in most cases leads to lower returns. Some specific examples we can see: media distribution, streaming competing with cable and broadcast TV. It's a perfect example of huge fragmentation going on in the market. Well, what's interesting about that market is you have consolidation in each segment, but the fragmentation is happening at the top. Airline and trucking deregulation is another example that happened back in the 70s, when before you were in this very regulated market, everybody had given amounts of, revenue and profit they could make. They deregulated it. Then all of a sudden it fragmented like crazy, and the profit pool just sort of went away. On the other side of the coin, you can look at companies who are doing consolidation, like in the equipment leasing area. You almost have a duopoly in the US amongst and certain types of equipments and geographies between Ashtead and URI. So that's a really, so the smaller guys are just, these guys just have so much more scale than everyone else. And so therefore they can offer lower prices, get higher returns than their competitors. Automobile distribution, we talked about that with Asbury and Lithia. There's other guys where that's sort of happening too. Value retailing, Academy of Sports, and At Home. At Home was a holding we held a few while back, but again, it was sort of going along the same kind of theme. And then connectivity, Consolidated and Frontier, the consolidation of that particular market. But that one also has this aspect that media distribution has, in the fact that you do have some fragmentation, but not quite as much as, let's say, the media distribution companies have. And so the real question in these things is where to get involved. Where's the best place to invest? And so one of the things that we try and find is, okay, most of the stuff that we're investing in, I would say it's really a combination of the earlier and later stages. The thing with the earlier stage is you need to make sure that the growth is going to be there, because it can take a while for this stuff to show up. And you can just take a look at the economics. How fast is the return on invested capital? And is the return on incremental invested capital increasing? If it's increasing really fast from a low level of ROIC, I think you have something that's interesting there. And so in the early cases, basically, it's with the top 5 having less than 15% of the market share. These are like US and European car dealerships. We can see really nice advantages, but they still have small amounts of market share, which means that this thing can just go on for a really long time. So the consolidation in the US car dealership market is probably going on 25 years. It probably can go on for another 25 because the top guy has like maybe 1 or 2%. So you've got a really long market there. And what that really helps to do is a lot of these trends we're talking about is basically to project them going forward. International auto rental is another one. US equipment rental and plastic packaging are examples of sort of where we're in the early part of the stage. So if you can find a company that right now has good returns on capital and very high returns on incremental capital, and it's early on, those are really nice things, because you can ride that for a real long time. Now you're dealing ones where there's a little bit more later stage. Those ones, they're already making good capital, but they really can't grow much more. So those are guys like the US auto rental markets. Probably there's like 3 guys that are in that market. So it's not going to grow that much. Another one could be sort of like can packaging. So can packaging, there's like 3 guys. It can work well. Traditional relative value works, but you're not going to get this compounding where you can repeat that process and keep it going up. And so it's really the early ones, I think, where we really spend a good part of our time to try to identify those where we can have really long runways and the things can continue on. So, and then the consolidation can also, depends upon specifically, are there favorable factors in the country or area you're looking at? Is the ownership of the company economically driven? If it's economically driven, you'll see them doing good capital allocation. If the ownership is other than economically driven, you see that they won't, or they'll do stuff slower, which we see in a number of overseas markets, where basically people are not as concerned about the economics, but maybe some other factor of why they're holding or running the business the way they are. For any regulatory or climate, this is helpful, especially in sort of the consolidation when you start to have larger market shares. And this is where you can run up against some resistance in the United States with antitrust, and then sort of supplier support. What do the suppliers think about these particular things? The suppliers can also have an influence on how all this plays out also.
This is Jessica. We had a question come in. I didn't want to let it get missed, but
Sure.
Peter asked, Lithia seems to trade at a low multiple to earnings like Asbury. If Buffett bought Van Tool because he likes this industry, why do the other publicly traded dealers trade at such a low multiple to earnings? Is there something that the market misunderstands about the industry consolidation story?
I think part of the reason is that, I mean, there's also another segment that Buffett holds that the market has. The comps are pretty low price too, and that's sort of in the mobile home RV sector. So I mean, you guys got like Winnebago and other ones, but specifically, I think what the market seems to be missing, and I think there's 2 different stories here. You've got the companies who I think are doing consolidation correctly, and they're focusing on that aspect of the market. Those companies like Asbury and Lithia, I think, are probably the 2 prime examples are ones where I think the market is missing it, and this business is going to continue to do well. But then you've got other players in the market like AutoNation, who's much more focused on just keeping their existing footprint and buying back shares. I mean, that's a different strategy. But clearly, if you take a look at, you take a look at returns over time, I think in the last quarterly letter, we sort of broke that out. The growth rate of Asbury and Lithia has been roughly around 19%, and AutoNation's been closer to 10. But I think what they're really missing is just the as the market's gotten bigger, they're really missing what's really happened to the market in terms of, it's getting better as it's getting bigger. I mean, the last time we had this big thing going on was 2008, 2009. You look at all these companies back then, and most of them were a quarter or less the size today. And when you're a small market where you're sort of just scrapping along, and there's things, different decisions you'd make. And as you're getting bigger, the economics are getting much better. Back then, you look at the economics were nowhere near what they are today. It's very similar to equipment rental. You can see the same thing going on there. You go back to the last recession, they had really big issues. Everyone was basically competing on price, and it just destroyed the industry. Now you're down to two big guys that are the major guys that aren't going to compete on price. They're going to compete on trying to provide better services. So I think what's happened over time is these industries have evolved. Their returns on capital have gotten better, but the market is not going to give them credit for that, because the last time these companies were in recession or had a big downfall, their earnings just collapsed. Now, and that's what's happening now. Everybody's predicting they're going to collapse. Well, if the economic recession happens and the earnings don't collapse, then I think the market will give them more credit. It's more of an evolutionary thing over time, because I think what's happening is the market remembers, everybody in the market remembers what happened last time. That's their point in history. That's sort of like their, I guess, the base rate they've got on their head. And it's a conservative way of thinking about markets, which typically works if you're dealing with, overall the industry is pretty cyclical, but within the industry you've got this consolidation that's making these businesses better. So what's really happening is, and then you've got other external changes that are going on that leads to uncertainty, especially in some of the auto dealership things, like guys going to the agency model, which basically means rather than the auto dealers selling to the OEM selling to the dealers directly, they just pay the dealers a fee per car to actually basically distribute the car to them, and then they order it. Now there's some guys that are going directly to that. Now the bigger scale guys, those guys are gonna be able to clean up on that, because they just have the scale they've got. They can just distribute cars in a much more efficient fashion than the smaller guys. So again, I think it's looking at the industry. I think there's a lot of people just sort of saying, okay, this is the way it was last time, this is the way it's going to be this time in terms of value. And there's a lot of people that are really skeptical of that there's been a change. And I think that's where the opportunity is to say, okay, here's what it was last time, here's what it is this time. Why do we think it's better? Why do we think it's changing? I think if you go back and you take a look at history, you'll see companies, this whole consolidation story. It's not only happened here, but it's happened in other industries. Consolidation makes businesses better in general from an economic perspective. And the question is, okay, have they really applied it to this? Are they going to apply it to this? I don't know. But I mean, that I think is the thesis in the way that we typically look at these types of things. Hopefully that answers the question in regards to specifically to auto dealerships. And I got into a few other things, but at least that provides, I think, a top level response. Just let me know if there's something else that you want. It's good to hear from you, Jessica. I can actually hear you now, which is great. So the next thing I'll move on to, unless anyone else has any other questions, is sort of capital allocation. So these things I basically talk about capital allocation champions. And so basically these are companies that are doing the right capital allocation. So basically, what is capital allocation? It's the investment of the cash flows that firms are receiving from their operations. And there's 4 or 5 different things they can do with the cash flow, right? They can reinvest it in the business, which is probably the best way to do it, because they know the business, they know where the high return projects, and they can do that. The second one is pay down debt. If they've got debt, they can repurchase shares, do M&A or consolidation, or they can spin stuff off, in essence. So those are what you really can do. And then you spin stuff off, you get some more capital, and you got to decide what you're going to do with it amongst these different things. So one thing you need to take a look at, I think, is does management examine all the alternatives? And one way you can measure how effective they are is, again, going back to this return on incremental invested capital, is just see what has happened to that over time. It becomes very telling. And one thing that really pointed out to me in a lot of cases was okay, what businesses should I be focusing on? Some of the businesses that we focused on historically did not have very high returns on invested capital. And right now we're involved in some of those situations, and they've turned into sort of special situations and that type of stuff. And so I think they're still interesting values, but they're not in some sectors, specifically like in telecom. However, so what I've really focused on are the ones where it's return on invested capital is growing. So in essence, you do have a tailwind. And then some of the key things that you can look at there, and this is why I brought up an Asbury, is share repurchases. Okay, everybody says, okay, we're going to repurchase shares. That's great. But what's the average price that they've repurchased shares versus the current price or current value? Now, as far as I can see in the automobile dealership group or group of companies, Asbury's done the best as far as I can see. AutoNation's done a lot of it, but they've continually done that. The nice thing I like about Asbury is they've sort of played it off against the other alternatives they've had, and they've decided sometimes it makes sense to buy back stocks, sometimes it makes sense to buy companies. So in my mind, they're looking at the full scope of what potentially they could do with capital allocation and choosing the best, which is I think what you need to do, because what the price of the stock is going to vary. And what you need to do as a manager is you need to decide, do I want to buy back stock or not, depending upon the price and what the market's is an input into your process of coming up with the best way to allocate the excess capital you're receiving from your operations. And then the other thing is growth is a good capital. What you really want is you want growth with good capital allocation and low valuation. That's where we end up in terms of looking at some of these companies. And the three examples I talked about up front are specific examples of that: Builders, FirstSource, Ashtead, and Asbury. And the best capital allocation, again, is dependent upon where the firm's development. And the real question you need to ask these things is how much of future growth is priced in today. When you looked at the multiples, the highest multiple was actually Ashtead at 15 times. And if it's going to grow 15 to 20%, 15 times isn't reflected. Usually a normalized multiple for something like that should be around 30. So in essence, you're not only going to have, if the trend continues, you're not only going to have this growth, but the potential for the market to reprice it and actually have it go up. And it's what some people call sort of the Davis double, where you can get some growth in the underlying earnings, but then on top of that, you get a multiple expansion. But I think for our underwriting purposes, we're not gonna count on that increase in multiple. We're just gonna focus on the growth aspect of it. And if we can get the growth aspect with it, reasonable multiple, and great. So a good example of this is actually Henry Singleton, who Warren Buffett says basically should be examined in business school. And there's not a whole lot of people that do it, but I've sort of been able to pull some stuff from some other sources that people have put together that really talk a little bit about him, to sort of examine him. His story is really interesting because what he's been able to do is he's been able to compound capital during his tenure at Teledyne at 20% per year. Well, what I think is even more interesting is the predecessor company that he basically spun out after he was no longer involved is actually able to compound at 18% for another 20 years. So I mean, think about that. I mean, he started out in the 60s, early 60s to the 90s. So that's 20, 30 years he's able to grow at 20% per year. And then from 99 to 2000, the company that had his legacy was able to grow at 18% per year. I mean, those are huge amounts over long periods of time. So it's a real interesting, I think, figure to take a look at. And so that's what we're going to sort of talk a little. Go short thing here. We're going to go through that. When he was the CEO of Teledyne, it basically was a conglomerate. He was an Annapolis and MIT trained engineer. He was an executive at Lytton. That him and his friend George decided to basically, with Arthur Rock, basically financing them, decided to start Teledyne in 1960. It went public in 61. They used M&A to develop sort of this conglomerate of a lot of different companies together, which was very popular at the time. They used highly valued stock to purchase fast growing and cheaper firms. And so they purchased 130 firms, and from 66 to 69, the net sales and income grew by like 5 times. So that's the initial setup on this. Then what happened was, after 1968, the valuation declined. Because and basically what happened then? Okay, well, you know, you have this upside, so you continue to do stuff, and you can have a real interesting sort of that, real interesting situation of the value going up. But then when the valuation stalled out and went down, then he sort of changed his focus. His focus was more on trying to figure out how to increase the return on invested capital of all the companies he had. The other thing he noticed was he couldn't buy 100% shares of companies for the same that he could buy minority shares in the market. So basically, he targeted firms, and he had insurance companies to buy them. So this is very similar to what Buffett had done. And then he repurchased shares. So what's happened? So what was the result of this? So the result of this, in terms of the focus internally, the return on equity of his company increased from an average of 11% in 1970 to 26% in 1980. So that shows the internal, and they would count one of the dings against some of these companies was that, oh, these guys were basically not investing enough. But for example, one of the companies they had, I don't know if you guys remember, the company called Packard Bell. They used to make TVs. And so basically he got out of making the TV business, and basically focused on other things and increased the return on invested capital. Another aspect of his business is he tried to keep CapEx about 33% of operational cash flow. So again, you had excess cash to do additional sort of investment in either buying back your stock and or M&A. Again, the equities, again, he says he found equities cheaper. It was 15 times. It grew up from 75 to 81. He repurchased 70% of his shares from 1970 to 84. And again, when you looked at what happened was he was buying back shares when the earnings yields were probably around 15 to 20%. And a unique thing that he's done, which when you dig into the details, you see he basically financed it with debt that was yielding 10%. So in essence, he was actually able to, what he did is he offered a tender offer, said, okay, I'm going to give you this amount, but what you're going to get in return for it is Teledyne debt yielding 10%. Because what he realized at that time was that the earnings yield on his business was so much higher than the debt yield, he was able to take advantage of that. So I think it was a very unique and interesting way to basically take advantage of that arbitrage. In essence, it was sort of like, it basically was, taking advantage of debt and basically being able to, create some additional value for his shareholders. And at the end, when he had all this growth through the 1980s, he ended up spinning off his insurance company. He sold his electronics business to Litton, which was the company he originally worked for. And he merged the company with Allegheny. And then at the end of this thing, they spun the business off. So again, so you see, he starts out, he grows it up through M&A. He basically, in the middle time frame, he increases the operations, makes ROIC better, buys back stock, does other interesting things in the middle. And then at the end, he spins it off. So he basically goes through the whole life cycle of this business and basically creating value all along the way. And at the end, he spun off, and there was 3 companies he spun off as Teledyne Technologies, Allegheny Technologies, which was the company they merged into that was more of a metals company. Teledyne Technologies was more of an aerospace and electronics company, and Waterpik, which was more of their consumer product company. But what's interesting is if you go back and you take a look at his track record for Teledyne was he compounded at 20% annually. And Teledyne Technologies, which was the spinoff that he wasn't no longer involved in, but had a legacy of what he did, actually generated 18%. So this guy is a sort of I would consider to be a capital allocation champion. He really understood what's going on. So this is an example of like what we like to see in the management teams that we invest in. So for example, Asbury, we see a lot of the similarities in Asbury, but again, it's going to be tailored to each of the different situations, but this provides you just a general framework and an historical example of a guy that really understood capital allocation, really understood how to really make it work for shareholders. And so here's sort of a summary of the key things that drove his success. Improving operations. And that's something we see, like, for example, in Asbury, you're saying, okay, well, they bought these companies. You see that they're not only increasing the operational efficiency of the business going forward in terms of turns and margins, but then they're divesting companies that they feel are not part of their strategy. So they're really sort of focusing on this aspect of it. And the other thing he did was purchase minority interest of firms when there was less for 100%. That may not necessarily be as much the case today, but if that happens, that's something else that he did. Buy back stock again, when he, again, not just buying back stock to like offset dilution or something like that, but buy back when it sells at a significant discount to intrinsic value. And then using bond consideration was an interesting thing that he did. In essence, I guess the equivalent of today would be, okay, if you'll finance a buyback with debt, but at this point, I'm not sure if there's that many people really look at it that way from that perspective. In mergers and acquisitions, you want to make sure you're receiving more than you're giving, and drives the currency you're going to use, stock and everything. And then finally spin-off. So Henry Singleton's done the whole spectrum of different sort of capital allocations. That's why I think he's a really interesting guy to really examine and model, to really look at in terms of other management teams, in terms of what they're actually doing with their businesses. So one final example here this is Builders FirstSource, is another one of the companies that we own that basically it's doing similar types of capital allocation that we see in Henry Singleton, and also associated with Asbury. So again, Builders FirstSource, similar to Asbury, it's a very collection of local distributions. What these guys do is they distribute building supplies. It's a local market where there's network effects and economy scale on a local basis. These guys have added value-added services, like for example, they'll provide truss assemblies and other parts of houses. They'll provide them out to the sites, basically, so they don't have to build them up there. They can actually build them in a factory and move them out there. They also have design software, which allows them to sort of get locked in customers. So not only will someone pay for the software, but then they can use that software to basically work on providing the distribution of their products. So it's a real interesting sort of synergy they've sort of put together there. Again, this is a large and growing demand with pent-up demand with U.S. residential construction. So this one's a little bit different than the auto business. I think there's really a longer term sort of uptick on this one. And again, these guys have higher ROIC and ROIC, as we mentioned before. The return on invested capital has gone from 13 up to 30 to 40. The return on incremental capital is like 80. So this one's just really doing well from that. And then again, these guys are doing the same sort of operational improvements that we see in Asbury, the same thing that we saw in Teledyne, sort of quicker inventory turns, local economies of scale, and merger synergies really just happening with these businesses. Again, these guys, they generate excess cash flow above what's required to maintain and grow their core business. About 35% of operational cash flow is required to maintain the growth plan they've got. And then management, again, sort of using these tools. There's from consolidation. There's been 15 acquisitions, 37 over the past 10 years. And again, they were purchased right now. They're at a point, similar to Asbury, about 30 some odd percent back in the mid 2000s. Excuse me, the 2010s. These guys over the past few years have bought back 38% of their shares. So again, using that, the capital allocation levers that they've got. They had this really big boom in housing over the past few years and made this tons and tons of cash flow as a result of it, and basically they're buying back the stock. Again, these guys have modest valuations compared to historical and expected growth rates for this business. So I mean, this is a similar pattern that we're seeing, and that's where I think we're really focusing our effort, is finding other types of businesses that are like this to take advantage, I think, of where the market's mispricing these businesses. And so just to sort of wrap up here, how has this process affected the portfolio of Bonhoeffer? So the key thing is one thing I want to sort of bring out that we talked about in previous ones, but I haven't brought up till now, is sort of right now with interest rates going up by 5% or more in fixed income. That means that the level of expected returns of stocks compensate has to go up by 5% too. And so what we look at is we're trying to look for guys where we can underwrite stuff and get at least low teens returns without multiple appreciation. And so that's sort of the bar that we're using right now. And what we've done, for example, some things we've done is we've swapped some holdings. We had some holdings that we thought were going to work fine, but we sort of see if it plays out. An example of that is we originally had an interest in a company called KT Corp, which is a Korean telecom company. When we originally bought it, it seemed inexpensive. They brought in a new CEO from Samsung. Before they had CEOs that were pretty much just corrupt and that kind of stuff. This guy wasn't corrupt. They brought in a new CEO from Samsung. And it looks like they thought the 5G was going to be playing out, but what happened? It didn't. I think there's a lot of aggressive reorganization that can happen in a company like KT. They have a very large real estate portfolio, which isn't related to their business. They could very easily spin out, but they've never spun out, and those types of things. And so we held on to it for a few years, and then we just said, okay, the management team, it never played out. So we said, okay, let's look at, if we just go down, we look at what's it currently. Let's say there's nothing that's really going to happen here from a capital allocation seemed to be slow in coming. Let's invest in a business where the capital allocation we know is growing, but we can get a multiple, closer to this. So what we did is we ended up selling that. We bought Builders FirstSource, which was something we had mentioned last year. The valuation was probably half of what it is today because it's gone up 100%. And then the other company that we bought some TerraVest. We bought another company called Academy Sport. Again, these are relatively, the multiple differences aren't that great, but the capital allocation upgrade is much bigger from that perspective. And so the one thing that we look at is if there's a new holding, as one thing that we have to really take a look at is we want to make sure everything meets these higher IRR thresholds based upon the newer, with the adjustment in interest rates. And so that's one thing that we looked at. And so that gives you an idea in general of what we've done and sort of where we are in our thinking in terms of Bonhoeffer. I'm really optimistic in using this, extension of a value approach and really seeing what's going on, because I think the market in a number of different situations is really missing sort of what's really going on, and it's being skeptical, which I think is right, a right to be skeptical, but I think that's just sort of what sort of played out. So I don't know if you've got, I mean, we did have some, I guess, some questions from that were sent in beforehand, which I think we can probably address now. If anyone else any additional questions, just let us know. Let me see if I can.
Yeah, Keith.
Yeah.
Keith,
Yeah.
I'm going to be conscientious of everyone's time. We're 5 minutes over the anticipated allotment, given our technical difficulties. So thanks for everyone's patience. But if you could quickly address the challenges and unknowns of investing in different international markets. How do you compare valuation, quality, and other factors to the U.S.? And maybe touch on some of the legal, cultural, country borders, and those ramifications.
Sure. So I mean, I think what's really happened there when you look at internationally is you need to use the same standards as we use in the US, and really take a look at, and that's why I think what we've noticed is, we have looked at and we found some interesting situations where the corporate governance and what they're really actually doing with the businesses in Europe have been interesting. Not quite as much in Asia. There is something in Asia, I think some parts of Asia we've seen, but I think that's why the portfolio has shifted in terms of where our focus has been to situations where someone is actually, doing something about coming up with better capital allocation. And then the question is, when you're dealing with foreign countries, you also have the other issues that you sort of need to step back and take a look at. What things do we take for granted in the US market that may not be taken for granted in other countries, especially when you're dealing with EMs. I mean, you're dealing with guys that may have different sort of, I would say, standards of what's appropriate and what's not. One of the top-down things we've looked at before is, okay, well, what countries seem to be moving in the right direction? And Korea seems to be moving in the right direction. At least the incentives are there moving in the right direction, because that's the first step you're going to see. Because you got to remember, the US market, the UK market, they're coming from a different perspective. It all came from the Anglo-Dutch way of doing business, and that's a new way of doing business. The old way of doing business is what everyone else in the world is still doing. And people are slowly moving towards this new way of doing business. And Korea the government has set up good incentives to move it that way. Now Japan is starting to do that too. So, what you'll typically see, like in Korea, they've set up the incentives maybe 4 or 5 years ago, and companies are slowly moving in that direction. But I think that's where I think there's a really interesting opportunity, is basically finding businesses that have good capital allocators, and whose governments and it's more than just the government. It's probably more a reflection of society is moving in the right direction in terms of having those incentives. And then you actually see companies starting to do it. Like, for example, one of our holdings in South Korea It's a company called Latte Chilsun. They're the largest beverage producer in South Korea. The Since we've owned them, the disclosure in English has just become excellent. And what they've done in terms of capital allocation of where they're putting their money, what they're doing with their money, has just really been outstanding. And you can just see on a quarterly basis, they say, okay, well, we're in the beverage business, and here's the areas we're going to focus on, and here's the things we're going to. So they're constantly saying, okay, we're going to pull out of this market, we're going to go into this market, the areas where you can get the higher returns. I think they've done a really good job of basically taking advantage of the incentives. The company originally came from an area where it was really sort of a challenge because there was a family feud going on and stuff like that. And now that that's past them, I think that's an example of in the emerging markets. I think there are some interesting opportunities, but I think you need to be confident that what's going on there, you as a minority shareholder in another country are going to be treated like you would as a minority shareholder in the United States or Britain or Canada or Australia or any of those countries that sort of have that kind of way of thinking about doing business. So yeah, so I mean, I think so I think what we've done in terms of doing the foreign countries is we've just defined our universe to include countries that either have the type of governance that we're used to. Again, that's being probably the former British colonies and Netherlands and Scandinavia, or are moving in that direction, which would be South Korea, and possibly Taiwan. But Taiwan, you still have the issue of what's going on with China, but still trying to stay in and more and more so Japan, still trying to stay in the areas where those values that have created shareholder value over time have basically are appreciated and encouraged by the governments, right? If you look at if you look at The Triumph of the Optimist, which is basically a study of 100-year returns for markets around the world, all the markets that have done really well have treated shareholders really well. It's primarily the biggest markets are South Africa, United States, Scandinavia. All these countries have treated shareholders well. They haven't looked at shareholders as patsies to take advantage of. They basically treated them as though they're partial owners in the business. And I think that's the biggest challenge you have in emerging markets is you still have this older way of thinking of, okay, maybe the shareholders are patsies and there's someone to take advantage of rather than someone to partner with. And so I think that's the challenge. I think we try to eliminate that by just looking at places where we think that, at least in emerging markets, things are going in the right direction versus not. So.
Great. Thanks, Keith. And then just one more question we had come in. Can you speak to your approach on valuation specific to business development companies? And this question actually came in specifically in light of your experience with Sixth Street Specialty Lending.
Yeah, I mean, I think if you're looking at from a fixed income perspective, I think what you really need, there are a few things you can really take a look at. From those, you want to find a good underwriter. So some of the key measurements there is you can take a look at portfolio coverage ratios. You can take a look at what's the key thing is looking at the track record over an applicable period of time. Sixth Street has a track record going back, the team does, back to 2000. They've been through it a number of times, and you can just look at what the net amount you're going to get from them. That's one way to do it. The other way to do it is just take a look at sort of the portfolio itself, which would basically be coverage ratios, give you at least some idea. And the way you calculate the coverage ratios, you take a look at interest rates today with today's higher rates and divide it by the trailing 12 months EBITDA. And really that basically narrows down the universe incredibly. So for example, the average coverage ratio in the universe based upon, Lincoln, which basically does a lot of valuations of these companies, about 1.3, which is pretty tight. That's EBITDA, interest expense to EBITDA. Guys like Sixth Street and Oaktree, Sixth Street has about 2.2. And what's interesting about them is their numbers stayed flat from the last quarter. What that's telling you is their EBITDA is growing as fast as the interest expense is growing. So again, that's giving you an idea that they're really doing good underwriting. I mean, Oaktree is another one. Oaktree Specialty is another one that has relatively high. There's other guys that are that are the big behemoths in the industry, the guys like Blackstone and Ares, they're like 1.7, 1.8. I mean, they're still higher, better than 1.3, but they're not the same as 2.2. I think the one thing in BDCs you got to be careful of is there's you want to, the discount to NAV can really be misleading, because in essence, it's tough to, unless you really understand the portfolio, it's tough to really see what's going on there from that perspective. So, I mean, I think that's the main thing. I think we had some other questions here. It looks like, let's see, returns on invested. Are these numbers return on invested capital or incremental invested capital? I think in the presentation, we've sort of differentiated between the two, but I think the key aspect of incremental is you think about return on invested capital as being sort of the base, and incremental is just adding to it. So if your return on invested incremental capital is higher than your return on invested capital, you expect your return on invested capital to go up. And those are the kind of situations we really want to see. There's actually a guy that does a really good job of laying all this out. This company called the UFP Industries, which is a forest products company that actually shows return on invested capital, return on the incremental invested capital is really high too, but they actually show here's what our target is. It's almost twice their WACC, and they've been able to achieve it. So, I mean, there's some companies that really sort of focus in on that. I mean, and it brings up another good point, is that most of the companies, I think, that really do and really understand the stuff and take this stuff to heart, you can see it in a lot of the presentations that they make. It's not like a hidden treasure you can find out, because if these guys are thinking this way, that's the way that their overall communication style is going to be, and you'll see it in just the way that they think and do things. And so that's the way I think that's one of the things when you look at these companies, you can try and find ones that may be doing this intrinsically, but a lot of them will basically just explicitly state this is what we're doing. And to organize a team around trying to go towards these metrics, you really need to have a good communication. You need to be able to communicate it not only to your internal teams in terms of what you want them to do, but you should actually easily be able to explain it to external investors also. Okay, so
Steve, we had a new question. I think I was able to actually get on and ask the other questions that were submitted.
okay.
But Rainer just question, what % of the companies in the portfolio do you think are effective capital allocators as you describe, like Singleton?
I'm thinking at this point, it's probably 60 to 65. If you go to the front of the presentation, you'll see the guys we consider to be good capital allocators, and then there's 7 capital allocation. I think we're between, if you take those two together, we're probably 50 to 60%, and we're going to move more towards that. I mean, part of what we want for some of the original investments we have, we're going to see if things are playing out. I mean, some of them have gotten involved in, like, for example, Consolidated and Millicom have gotten involved in special situations where you've got people bidding for the company and basically trying to take out, you got a lot of external guys basically bidding up the companies, bidding up the value of these businesses. And at this point, I don't think it makes sense for us to basically leave those and go into these more of these capital allocation guys. But there's other guys where we've held the position for long enough, like what we've done with KT. We've observed what management has done, and we've said, okay, well, here's another management team where we can get about the same multiple, maybe a slighter multiple, but that capital allocation is a lot better. Those become a lot easier switches. And those are the kinds of things that we're doing through the portfolio right now, is basically moving it more in that direction. And I think going forward, that'll be more of the things, because when we originally went through a lot of these, we had some kind of a thesis. And if the thing doesn't seem to be playing out, then it's time to move on and say, okay, let's take our capital and put it with these guys that are going to be continuing to grow. I just think that, over time, when I've studied more of these guys, I've become more and more convinced that it should be a key part, and it is a key part of sort of what we're doing in terms of evaluating management from evaluating management in terms of who we want to be partners with, and how are we really being treated versus not. So that's what we'll see. What we'll see going forward. I think, like saying, we've identified, I think, probably 2 or 3 other companies, I think, that are really interesting in sort of this, what I would call great capital allocator type model. And we're examining some of the existing portfolio holdings and sort of seeing, okay, the ones, what we do initially is we're going to exclude the ones that are sort of in this bidding war type of thing. We want to sort of, but when those monetize, then clearly those will go into this. But then we've got some other longer term holdings that just have not, the thesis is just not played out. And now we're assessing, okay, well, what's the best place to put the capital from that perspective.
Great. Well, I haven't seen any more questions come in. Really appreciate everybody's patience throughout the technical difficulties. Apparently, I was the mole. I was causing the difficulties. So sorry about that. Do hope that everybody got something from the presentation. If you had a question after the fact, please don't hesitate to reach out either directly to Keith or myself. I'm happy to set up individual calls. And we look forward to continuing these types of periodic events. And thank you so much for joining us. Have a great day.
Have a great day. Thanks.